Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Thursday afternoon edition. We are going to talk about, I should probably get that damn camera on today, folks. I don't know why my camera decided not to work, but we are going to talk about bonds. We're going to talk about yield. We'll talk about the Treasuries. We'll talk about the Fed. And hopefully we'll talk about my camera that should click on any moment. There we go. Look at that bright-eyed and bushy-tailed. Not going to shave. I think we're not going to shave for the month of November. It's that whole November thing. Anyway, obviously Jerome Powell's comments yesterday gave a lot of optimism to our equity markets, and that's going to be kind of the topic du jour for today. We saw just colossal moves, which I had not seen coming. I did not expect to see these moves to the upside today. It is the 2nd of November. My guest joining us from the East Coast, talking about Fed analysis and interest rates. We've got Mr. Bill Addiss joining us. Bill, how you doing?
Hey, Merlin, and to everyone, good afternoon.
Good afternoon and good markets.
Yeah, if you're long.
If you're long, yeah, wow. It's funny because I got out of my long positions on Tuesday, right? At some point on Tuesday thinking, I don't want to hold it on Wednesday. I don't want to worry about Jerome Powell. And then I didn't want to get involved with the Apple earnings. And man, if I just kept that position I had long, shoulda, coulda, woulda, man, it would have been a huge gainer. But oh well, we're happy with the gain I made on it.
There you go.
Let's talk about Mr. Powell and his most recent conversation. And there was definitely discussion in there about pausing. And I think I want to start there. I think that these markets rallied significantly today and yesterday, really, based off the expectation that the Fed is done. I mean, he made it sound like he was done. He said these two statements. He said, if he experiences job contraction or evidence that growth is consistently above potential, then that may lead to raising of rates. But he said those are his only two. I noticed that's not inflation. It almost said inflation.
Growth above, but when you say growth above expectation, the second one.
Yes.
We had a GDP number came out last week that was phenomenal.
Huge.
Doesn't that give the Fed more room to have to hike?
And that's why
Didn't he get what he's already prophesizing could make us want to raise rates? It was exactly what we got last week.
This is why I wanted to talk to you about it, because part of me scratched in my head, because he did early on in the press conference, he said, we've got 4.9% GDP. That's due to, increased consumer spending, which of course can drive inflation higher. His 2 points that he said could lead to further rate increases were evidence of growth consistently above potential. Now, does that 1 point data, that 4.9%, we were consistently below that for a long time, right? That is 1 point data, and I'll bring up that chart here for everyone to see.
Sure.
But how would you interpret that, from the perspective of increasing rates?
Yeah, no, I start with the argument, and when I look in the thesaurus as to what the word pause means, it's very different than the word halt. And, I heard him say pause. I never heard the word halt. And I also keep coming back to my fundamental tenet. If we are committed to 2% inflation, why do we start with the assumption that the Fed's job is done?
Right.
We haven't achieved the inflation has come down dramatically. That's great. But why are we done? I don't understand. And I look over the wall at the equity people and I see a degree of optimism out of the equity market where they're looking to reinterpret things. Pause is not a halt.
Yeah.
We've got strong signs of economy. We know what the labor situation is like. What's the argument for the Fed is done? I would play the contrarian point of view.
Yeah.
What is indicating the Fed's job is done?
Well, I think it's, everyone digging into what he said. And, he said we're going to continue to hold rates where we're at and see what happens with inflationary data. Of course, they always cite PCE, which is up 3.4%, and they had core PCE, which is up 3.7%. He talks about those numbers right there.
Right.
But yeah, when I heard him specifically say at the press conference, he isolated it down to those two things, and I went, I'm pretty sure that what you meant to say was three things. Number one would be a persistently high inflation number should have been number one. Number two would be, job contraction. And number three would be, an overheated economy. So those three variables there, because let's be honest, evidence of growth consistently above potential has nothing to do with the Fed's mandate, right? That's outside the scope of what they're supposed to do.
Right. Yeah. Yeah. No, well, the Fed can choose what mandates they want. Let's be honest. They can choose, it's inflation this week, it's the economy next week, so they have that flexibility, and we can make the dual mandate a three-legged stool.
Yeah.
But I really, and please understand, I know your show yesterday, I'm sorry I missed it, was about the bond vigilantes, one of my favorite topics. And I think they're going to be back.
Yeah.
Rates are going higher. I really do believe it, because I'm having trouble finding the arguments why, other than I would like it to be true argument. Mm-hmm. And then, certain markets would like to see that. I'm still looking for a compelling argument why the Fed is done.
Yeah. Maybe, you know what? Maybe you should read my next article coming out for barchart.com.
I mean, I'm not as pessimistic as Jamie Dimon saying look out for 7%.
Yeah.
But I do question. And what we're really seeing here is, and I think it's worth noting, look at the volatility we're getting out of 25 basis points in interest rate changes.
Right.
Look at what's happened, not only by what the Fed said this weekend, but what the markets did. And, we're just seeing incredible volatility as the marketplace is digesting this. I mean, I refuse to believe that the news this week, from the bond market alone, is accounting for, what are we getting now? 3% in the last 2 days on equity prices?
Yeah, more.
Talk about the wind in the sails.
Yeah, I'm going to bring up the daily here just so we can all look at that real quick. Here's the last couple of days, and we'll talk about Apple. I know a lot of you are looking at Apple and wondering how bad Merlin got shellacked on his short trade. We're not doing too great. You're looking at a 7.3. Oh, that's Apple. 7.3% up for Apple in the last 5 days. But let's go triple Qs, and then we'll go to the SPY just to look at them both. Off the lows that we saw from Thursday, October 26th, to the peak. So 6.23%. In the last 5 trading sessions for the NASDAQ alone. We can go to the S&P 500 here. This to me is just screaming, overt optimism. S&P 5.3% in 4 trading sessions. So that's remarkable moves.
I mean, you would think that Powell said we're cutting.
Yeah.
That's on an unchanged policy. That doesn't make a lot of sense to me.
Yeah.
Nor does the bond market volatility. I'm not just picking on equity volatility. The fact that we moved 20 basis points on the 2-year in the last 3 days.
Right.
Volatility is everywhere. It's just rampant. And that scares me a little bit.
Typically you don't see that kind of volatility in a 3-day window of time. 20 basis points is pretty
Absolutely.
Damn significant. What is that, if it tells you anything, what does that change in the short-term yields of like that indicate to you? What does it tell you?
In the short end of the market?
Yeah.
Well, if you look at the real short end, the bond market is really saying that the Fed is done as well. But at the same time, we get mixed signals, because if you look, we've seen such huge yield deterioration in the long end that we're back to a more inverted curve. We were starting to lose the inversion for a couple of weeks there.
Yeah,
and the gap was narrowing. And boy, it took a substantial hit yesterday.
Yeah.
So the bond market, yeah. So the bond market is really, once again, signaling tough times ahead for the economy.
Well, I look at this difference between the 10 and the 2, which is what we're looking at here, guys. For those who might be new to the program, This is looking at the yield curve inversion, how much it's inverted. And in this picture, we were at 15 basis points worth of inversion 2 days ago, and now we're at 33. So essentially, we've doubled the rate of inversion in 2 days. But
exactly.
But I would make the argument that, looking at this 10 versus the 2, it's on a pretty decent uptrend back up to 0.
Oh, yeah.
It is making some higher lows, higher lights. It's looking pretty good here, even though it's a tremendous pullback today. I do think you're going to get back up to where the 10 equals the 2. Now, if that happens, that means that the 10-year is going to be over 5%. And
that's my argument. Long rates are going higher. The curve will uninvert, not because the Fed's doing anything, but because the long end's going to go higher.
Yeah. Yep.
Yep.
One thing that I I wanted to pick your brain on, and from my years of interacting with you, and I give you almost all the credit. I give John O'Donnell a sprinkling of credit there too, for my bond understanding, and I guess just my curiosity for how the bond market works. So thank you for torturing me with a new interest in a financial asset class, you jerk.
Sorry about that. And the same apology to much of your audience over those years.
No, it's okay. I'm sure we love it. I always make the reference that the equity market, all the markets, the global financial markets, is like opening up a watch, an old classic watch with all those dials. And if you think you just focus on this one cog, you're not going to be able to tell time. But all those pieces together, you get a better, and you never nail it perfectly, but it does help understand where it goes. So
absolutely.
You made the point that, as we get more debt, and to pay that debt, the Treasury Department issues bonds, issues 10 years or whatever, to raise money to pay the interest due on that debt. As we get deeper and deeper into debt, they're selling more. And because they're selling so much, yields will tend to rise. Remember, you put more supply out there, the price of those bonds will drop, the yields will go up, which is what we see with TLT in the long term. That's just the Treasury Department. So far, am I correct?
Yep, okay. 100%.
So just the Treasury Department covering the debt for the United States leads me to believe rates are going to be going higher. Then you couple the fact that the Fed in the last year has unloaded $1 trillion worth of securities. That's mortgage-backed securities, treasuries, different maturities, but certainly there's some long-term stuff in there as well. If they're unloading that much, $1 trillion, that to me says I've got another selling influence in the bond market, more supply coming to market, and therefore yields are going even higher. So I feel like I got a double whammy. It's almost like a short covering and someone going long at the same time. To me, I think we should be seeing yields surge much higher from here.
Yeah, no, the quantitative tapering, exactly as you described, does put upward pressure on rates. And I also have to throw out, without getting too political, you're right. We have to borrow more money simply because rates are going up. And it costs the government more to borrow money. Right. Every 1% raise is $300 billion of just extra interest expense. Excuse me. So it gets caught in almost like a trap. Yeah. So you have to keep borrowing more. So yes, no, both of your factors are right. The only thing I would say is the other problem is, and this is where we get a little political, is even without the increased borrowing costs, interest rates, our government continues to overspend. It's just unchecked. So we just finished up the year at 1.7 trillion deficit, our second largest ever, I thought was an improving economy. The supply situation continues to be a little bit problematic, to say the least. And what the press has been focusing on, and I'm glad to see it because we've been talking about this for 6 months, is the demand side of the equation. Right. Who's buying all this paper? The Fed's not buying it anymore. Foreign central banks aren't buying it as much anymore. It's the dealers and the retail investor are holding the back of the market up right now. Yeah.
And that's the conundrum, is where is this buying coming from that's propping it all up?
Yep. So, well, it's not. We are seeing this upward pressure to rates. So we're starting to experience it. Last quarter was the largest quarter we had. And I should have come into the class or the session more with my notes as to what interest rates did over that 90-day period. But long rates went up substantially at that period of time where we were just issuing boatloads of long paper. Yeah. Yeah, it's a conundrum. It all comes down to supply and demand fundamentally, doesn't it? No matter what market you're talking about. Well, it all comes down to supply and demand. And Ganesh brings up a good point here, which is, we've kind of talked about this a little bit, which is, he says, if Japan and China, who were the holders or some of the largest buyers of bonds out there, they're not eager to borrow at 5%, who will buy U.S. bonds for the government to fund? And that's the $50 trillion question, is it not? Like, if you're selling more of these products that fewer people are buying, how am I going to unload them? Yep. I mean, we've been spoiled, right? We have borrowed more than any other government in the world by far. Yeah. But yet, because we're a reserve currency, because OPEC trades in oil, because stock gold and other commodities, we have demand for our securities as a result of that. But those conditions are changing as well. I've stressed to you, I'm really scared that OPEC is now doing transactions not in dollars, but in local currency. Right. Mm-hmm. The whole reason Kuwait and Saudi were the number 3 and number 4 buyers of our bonds is they had so many dollars from all of their oil sales. Well, now they're selling oil in rupees. So guess what? That means they don't have to buy as many bonds because they don't have as many dollars.
Mm-hmm.
This is really a problem.
Yeah, and which will probably continue to build up.
Yep.
All right. So now you've added another wrinkle to here, which I need to fill up my this void in my brain, which is, okay, I get that the Treasury is unloading because they need to fund the government. I get that the Federal Reserve is unloading because they built up an ungodly large position of assets that they probably never should have gotten that big, right? They've gone from 8.9 trillion now to 7.9 trillion on their balance sheet. So bravo for liquidating, but you're actually helping yields surge. And of course, the Federal Reserve is supposed to be made up of banks who are getting screwed by these rising rates. I'm like, wait a minute, how's it happen? Okay. So those are the two.
You got it. It doesn't have to make sense, but you've described it perfectly.
Scratch my head and go, okay, this seems so weird. So based off that, you made a comment, which I want to touch on again. You said that a 1% raise in interest rates equates to $300 billion. Is it not annual? Or how? What's the
annually?
Annually, $300 billion. Okay.
And it's just as simple as with $33 trillion of debt out there. If we assume a linear 1% raise in interest rates, then refunding that debt is a $330 billion change.
So I've got 1%. Two forces. One, 100% government, which is the Treasury. The second one, which is not government, but is certainly tied fairly close to the government in the Federal Reserve. So I've got those two aspects. Their actions are forcing yields higher. Then you're saying, and I'm playing devil's advocate here because I don't know the answer, but if I'm a government and I'm like, well, shoot, man, every time this goes up 1%, we're paying out an extra $300 billion. We need to do something to stop the yields from going up so much because it costs us money. Obviously, you want to repay our debt at the lowest possible prices that we could. At what point does the government, I mean, how does it work? Can the government step in here and just start slamming things down because, force it lower?
Through what mechanism?
That's what I'm asking. Like, I don't know how they would do it.
There is no market dynamic, any more than the government could say, we want Apple stock to go up 20 points today. Right. If somebody wanted to do that, but understand, what you're describing, and I love the way you described it, is a fundamental, almost a dynamic shift between the needs of the central bank monetary policy and the needs of the government fiscal policy. But that's the way the system was designed for that.
Right.
And the best example I give right now is Japan. The Bank of Japan is still doing quantitative easing. They're still printing up money to buy the 10-year. And that's so devaluing the yen that the Japanese government, not the central bank, the Japanese government keeps feeling obligated to step in and keep supporting the yen. So here's the central bank driving down its value through quantitative easing. Here's the government buying it to try and support it. And they're doing that battle in the marketplace. Yeah. So to have fiscal and monetary policy kind of be, I wouldn't say at odds with each other, but they countermand each other sometimes. Mm-hmm. I mean, when the Fed raises rates, it costs the government more to borrow money. And I would point out that certain politicians would say, and we know how many jobs we're going to lose as a result of raising those rates. Yeah. If your job is maximum employment, why are you raising rates?
Yeah.
Isn't that the very violation of your basic mandate?
It's funny because you think that, the raising rates are costing the government more, then they need to issue more debt to cover that. And all of a sudden you're exacerbating the problem. And I just I don't see a way out of it.
I'll add one more wrinkle to this. I don't know, but the Fed has raised short-term interest rates so high, and the Fed is engaged in so much repo now that they're actually paying those high interest rates to banks and brokerage firms, that the Fed has now put themselves in the position of losing money.
Which
they
never
do this year for the first time ever. First time in their history. The Fed's going to lose money, and they're losing money because they themselves raise short-term interest rates so high that they now have to pay those rates to borrow money. So their actions put them in an unprofitable situation.
Well, and they're also selling these bonds that they have purchased, and the yields have gone up. Therefore, the value of those bonds has gone down, so they're losing on those bonds like banks did.
Well, I was going to let that slide, but I want to.
Don't let it slide. Go for it.
No, because the reality is, you're right. The Fed is doing quantitative tapering, destroying about $100 billion a month, but 90% of that is actually coming from maturing bonds.
Okay, so it's not. They're simply held to maturity.
Exactly. Okay, so they're simply taking their rolling off debt and destroying that money. Now some months they do have to go in and sell a few bonds. So I don't disagree with the premise, but most of the money is from their maturing short portfolio.
Yeah. Okay.
And
good.
literally when the treasuries mature, they just destroy that
Which
money.
makes it then a fairly easy model to predict what they're liquidating, because if you go, I think if you go to the New York Fed site, you can see exactly the holdings, exactly when they mature. Okay, good. And that's why I said that kind of half knowing that, and I wanted to make sure that it got caught, because if they were forced to sell before maturity, then most likely they'd be taking losses on those bonds. And guys,
absolutely,
this would happen to Signature and First Republic.
Exactly, that would put them in a Signature situation. Right. Exactly. No, they're able to get 90% of their funding just by letting the stuff roll off.
Nice, great. All right, well there we go. That can make me wipe up some beads of sweat off my brow, thinking the Fed might go. Fed might go the route of Silicon Valley Bank. Like, wait a minute, who bails out the Fed?
Well, that's the beauty. Just for the record, when the Fed has a profit, they turn that money over to the government at the end of the year, $97 billion last year. When the Fed has a loss, they're going to print the money to cover their losses. It's nice to be the Fed.
It's good to be the Fed. I wish I could do that in my account.
Me too.
I had some losses. I'll just print up some money to cover it.
It's good to be the Fed.
It's good to be the Fed. You sent in some materials, and I want to real quickly look at these. You had a bunch of illustrations, and you talked just about a 3-day difference in rate. So I'm going to bring up that graphic here, which I think is pretty interesting. It says what a difference 3 days can make. Explain this graph, and then kind of why is it so important to you as a bond guy?
Yeah, no, great question. So what we're looking at here is the yield curve on Friday in blue, and then the yield curve on Wednesday after the Fed announcement, after Tuesday's and Wednesday's volatility in red. And what I'm really just showing here is the dramatic shift in yields in such a short period of time, as we were already discussing. But what I like to reinforce on these points is the point I'm always making is that changes in interest rates are not linear. The short end has an identity of its own that's basically controlled by the Fed. And that's why those rates haven't changed substantially. But the marketplace sets the long-term rates, and having nothing to do with Fed activity, honestly. And, what we're seeing here is the market was responding to an awful lot of other things, particularly in terms of supply. The real news for the bond market this week has not been the Fed. The Fed didn't do anything. We were expecting the Fed not to do anything. The real news is in the supply situation we've got going forward. The fact that the government's going to be issuing less of the 10 and 30 years than they are of the 2s, 3s, and 5s. Mm-hmm. And that's a major rebalancing. So we were really hit by the fact that we're not going to get that abundance of supply that we were talking about, at least for the next 3 months. Okay. So that has the opposite effect, right? Mm-hmm. Drives up prices, drives down yields. So the marketplace was reacting really not so much to what the Fed was doing, but to the supply situation and the quarterly refundings. The government's only going to have to borrow $796 billion this quarter versus change. Over $1 trillion. I know, chump change, exactly. Versus $1 trillion last quarter. Yeah. So there were some real shifts to the fundamentals of supply this week as well. And those announcements were on Tuesday as well.
Yeah, I'm looking at your, you said auction schedule is light on increases in long issuances.
Right.
Good stuff.
So they're going to increase. Now, in government talk, to decelerate your rate of deficit is good, right? Yeah. God forbid you actually have a surplus. So what I mean is for the first quarter, the government is going to be increasing by $3 and $4 billion their short-term offerings, and only increasing their long-term offerings by $1 billion. So they're still going to be issuing more.
Right.
They're just not issuing as much as they are in the short end.
Okay. Let's say you got all kinds of good stuff here. I'm just kind of looking at it. So Fed funds.
So next week will be the clue. Yeah, next week will be a good test. Next Thursday we have a 10-year auction.
Okay.
So the marketplace is really going to be looking at this whole supply and demand dynamic. The auctions give us a snapshot as to who's buying. So that 10-year auction, the marketplace is going to be looking at Thursday. So keep an eye on that. And then Friday, we have the 30-year auction. And I don't know if you remember, I was on your program 2 months ago. Remember when we had that 30-year auction results that were so abysmal?
Yep.
And equities traded down like 1%, as I remember it that afternoon? So these markets, these auctions are starting to get real focus. So pay attention to the 10-year and the 30-year on Thursday and Friday next week. A lot of focus there.
It's funny how... There's always, I feel like there's always an evolution of what is a market driving piece of news or data.
Isn't that the truth?
Interest rates are always there, but now the bond market is center stage, and I never thought that I'd be sitting there watching a bond auction, trying to anticipate, my next equity market trade. Kind of fun.
I have had equity friends that I've had for decades talking to me these last couple of weeks saying, why do I care about an auction? Talk to me. I've ignored you in this humdrum stuff for years. Why do I now care? And the reality is you care because the markets now care.
Yeah. Absolutely. One other thing that was brought up here, I saw a couple comments come through. You mentioned it in the past. It was talking about I-bonds. Obviously, I-bonds last year were looking at 9.6%, and then all of a sudden inflation was under control, according to Paul Krugman. And we saw it get crushed much lower, and all of a sudden those I-bonds weren't paying as much. What's the new update?
Yeah, so the update is, and you're right. When we started promoting this, and I think we did promote it because I thought it was a great opportunity. During the pandemic, about over 9% government yield because these I-bonds are pegged to inflation. And inflation, as we've just talked about, has come down dramatically since then.
Right.
So we just got the new reset. These bonds reset every 6 months to the inflation for the prior 6 months. Now, we just got the new coupon Monday for the next 6 months. Now, the new coupon is 5.27%, which I would make the argument is still a pretty attractive rate of return.
I'm fine with that.
Yeah, I look at this as a 5-year piece of paper because after 5 years, you can just redeem it. Right. But what's interesting is Janet Yellen, we owe a great thanks to, because if you just look at the changes of inflation, the coupon of this bond would have been under 4%. It was going to be 3.97. That's based on just the inflation changes. But at her discretion, the Treasury Secretary can opt to juice up the yield on us. And that's exactly what she did. She gave us an extra 130 basis points.
Wow.
So the coupon is 5.27, and 1.30 of that is a present from Janet Yellen.
What's the logic behind Janet Yellen doing that?
Idea.
I mean,
I have no idea.
I think I know. My hypothesis would be that it's to make these more attractive, to get people to lock in at 10-year, because she feels that down the road there might be some higher rates. So I'll make it exciting and enticing for people to buy in at this level. I don't know.
I don't either, because I'll venture many people who own these bonds don't even realize that she's involved in this at all.
Yeah,
and don't even know to give her a thanks. But the real issue is, I can't be a hypocrite. On the one hand, I can't be, berating the government for being fiscally irresponsible, and then here's Janet Yellen juicing up an extra 1.3% to government debt for reasons she can't explain, and most people won't even understand.
I mean, imagine I sold you a car. I sold it and you paid me $20,000 for the car. Our deal is done, and I just give you another, here's another $2,000 on top of it. Right. I'm like, well, hold on, wait, what?
There you go. Right. And, it is strange. So I don't understand, nor has she ever offered an explanation. Last reset, 6 months ago, she juiced it up by 90 basis points. This reset, she's up to 1.3%. So thank you, Janet. That's the only message I have. Thank you, Janet.
Yeah. Thank you, Janet. I'll thank you as well, because you just added 1.3% of my yield on my I-bonds.
Exactly.
NJ says,
go ahead. Oh, go ahead. I'm sorry, please.
NJ says, where can I place cash safely now? CDs is one way. As you'll probably get chatting in here from a bunch of people, you can just go short term. Go to treasurydirect.gov and buy 3-month bills.
Yep. Money market funds at 5.25%. Anything at the short end of the yield curve, depending on how much credit risk you want. If you want government backed, you can still get over 5.25%. If you're willing to take some risk, like a money market fund in terms of credit risk and things of that nature, you can get closer to 5.5%. But the inverted yield curve that we have today really incentivizes you to keep your money short. You're being compensated for it.
Yeah,
absolutely.
And the truth is, at some point that's going to change. At some point you'll be rewarded more for buying a 10-year bond. And, if the short end of the yield curve, let's say the 3-month is going to give you 5.25%, the 10-year should be giving you 6.25, something like that. But we're not seeing that right now. Right now we're seeing that short end paying you. So as a lot of people in the chat will attest to, go buy those 3-month T-bills and just enjoy it. Just sit there and roll them every 3 months.
The only thing I would caution is, and not caution, but I would urge people to do their homework, is, banks right now are pretty flush with cash. Banks are sitting on pretty healthy cash reserves. So the bottom line is they don't really need your money. So the CD rates, as a generally speaking, as an asset category right now, are not particularly attractive, but that can change institution. You can always find one that's out there paying a above market rate, perhaps. But generally speaking, bank CD rates right now are not overly attractive.
Yeah. Well, it's up 5%.
Again, everything's relative. If you're competing with a 5.25 Treasury rate, all of these rates are nothing to sneeze at. But on a relative basis, banks aren't willing to pay up over those rates to get your money because they really don't need it right now.
Yeah.
Not a lot of mortgage buyers coming in the door.
When you see banks that are flush with cash like that, does that give you optimism about the overall markets? Because you're sitting on cash, that means you have capital to deploy. To me, that does seem like it would be a positive factor for the markets.
I would agree, but I also have to add the cautionary note, being the banking nerd that I am, is I would hope the banks are flush with cash because they don't have reserve requirements for the most part.
Mm-hmm. Right.
The fact that they use their reserve requirements were lifted during the pandemic. Somebody explain that to me someday. When there was more banking risk in our system, the Fed loosened up the credit. But anyway, they don't have to they still do, but if they don't have to have money committed at the Fed, that gives them more available reserves.
Mm-hmm. Nice. Johnny on the spot, Mr. I saw your Donald McDonald costume. I like that one. He says, is it a good idea to invest in gold? I would make the statement that nobody can say what is a good investment, right? It's up to you and your risk tolerance. I am long gold, so I do own gold for the long term. I look at it as a long-term play, as a hedge. But if you look at the chart of gold, Johnny, it doesn't look very good. The chart of gold has been underperforming. Personally, if I had to choose between, I know I'm going to get some slack on this one. If I had to choose between gold and Bitcoin, I'm buying Bitcoin. I know Bill's going to be like, what are you saying, man? One is not backed by anything. I'm looking at rates of return. From a stability perspective and safety, sure, you can allocate some to gold, but out of your total portfolio, for most financial advisors, it shouldn't be more than 10% of your holdings in gold.
I'm with you. I will admit I don't understand gold. You can't eat it. Doesn't pay a dividend. Only valuable to the extent that we think it is. The whole world's supply can fit in a tanker.
Yeah.
I don't understand the gold market, I will confess, but I do know, and you, I'm sure, can attest to the same thing, that although we think of gold as a haven of safety and all of that, on longer term, the single most important factor to gold is interest rates.
Mm-hmm.
Like any other commodity, you're carrying charges.
Yep.
So gold is as much an interest rate play for the long term as anything else.
And if you look at the cost to store gold, if you're going to keep it in your home, better be careful and have some shotgun around the house. You look at the storage cost for Bitcoin, that's really up to you. It's really just up to you on where you want to keep it. And there's no carrying cost. There's no storage cost. It's right on a digital wallet. It's super easy to do. One thing that you'll hear more about here is the government can confiscate your gold. The government can confiscate your shares of Apple or Google, or they can confiscate all that stuff. Janet Yellen was testifying the other day and making it a point that self-custody should be prohibited, meaning you should not be able to take control of your own money and do what you want with it. That's something that you and I should look at as a violation of our fundamental rights in the United States. Is we do have the right to own things, and Bitcoin represents something that's outside of that. I can actually own Bitcoin. I have it right here. They cannot take this away from me. Good luck seizing it. You have to have my private key. Without that key, you'll never get it. So this is an interesting dilemma, I think, that's going to become much more evident in the coming years when governments try to control what we do with our capital much more, because decentralized marketplaces are giving you the ability to not use these institutions, and that's what scares them.
Yeah. Oh, absolutely. And by the way, the idea that the U.S. government can seize gold, that's more than a theoretical discussion. 4 times in U.S. history, our government has seized gold. We have gold ETFs like GLD or IAU. I mean, there's $100 billion in gold ETFs, and all of those ETFs keep their gold outside the U.S. They keep it in the UK because there's considered to be political risk to hold gold here in the U.S. BlackRock doesn't hold their gold here in the U.S. for that reason.
Wow. All right.
That's not just a theoretical. That's real.
You mean this mythical place called Fort Knox doesn't have all the gold they say they do?
Fort Knox is a museum. Fort Knox has no gold except what's in the museum.
But they tell us it
does. The gold's at the Fed.
Yeah.
The Fed holds 80% of the world's gold. New York Fed holds 80% of the world's gold.
I love that one. 80%, right? Man,
all in one building.
So,
Yeah, remember the old Die Hard? Remember when they were stealing the gold
yeah,
from the New York
yeah,
Fed?
yeah.
That was really that's the way it is. 80% of the world's gold is at the New York Fed.
I'm sure you have had an experience that far eclipses mine, but I'm still young. So, I when I was in college, I ran a financial management organization. It was like a little club for the finance nerds, and
Cool.
I ended up booking a trip to the San Francisco Federal Reserve. So we went down there, and they walked us through the whole thing and showed. It was really a fascinating experience. And then they took us downstairs into the sorting rooms, the loading docks, and I was like, you're in the bowels. Like, you had to really have access to get into this place. And then they walked us to this wall. I remember it vividly. It was like on the left-hand side with these gigantic, there's a circular entrance with just gigantic steel bars. And there were pallets of carts full of money from floor to ceiling. And it was like 30-foot ceilings, right? And I was just in awe. Yep. And the guy that gave us the tour goes, look to the right. So we looked to the right, and there's another room that's equally as protected, and it was floor-to-ceiling gold bars. And I was like, oh, I've never seen that much gold in one. It was pallets of those 400-ounce gold bars. And I was like, oh, man, that's where you keep it? Where's my ski mask?
That's just for the regional. That's right, and that's just for the regional. I mean, San Francisco's a big region. It's all of California. Right. But the New York Fed is holding not just the East Coast gold, if you will, but it's also holding most of the foreign central banks' gold also.
Wow.
Incredible amount of security. It's only 2 blocks away from the New York Stock Exchange.
It was so weird just to kind of see that much first. Because you see it in movies, and everybody here knows 100% that the crap you see in movies is all fake. When they show a pallet of cash, it's all fake money. To actually look at something. And, it was also interesting, in that Federal Reserve building, they had these glass cages. And there were 2 people next to it. It's like an operating table, one of those steel, where they do autopsies on. And one person on each side, and this pallet or a cart would come through, and they would just stack the cart and go through it, and then they would feed it into a destruction machine, and they would just shred all this money, but making sure it was all such a bizarre experience.
Yeah. Well, the dollar bill only lasts about 6 months. The dollar bill is so economically inefficient. We should do what Canada does and do a coin. I mean, because you have to replace them every 6 months.
Yeah. Or at least go to something like when I was in Jamaica, they were plastic.
Yeah.
Which is a little bit better, right? It's going to be slightly cheaper because dollar bills are cotton and other grains, plus all the security measures that are in there. Seems like it'd be much easier to do from a plastic perspective. Plus,
when you making an argument? I'm sorry. Go ahead.
Plus, when you jump in a swimming pool, I don't have to have this soggy dollar anymore. I can just go wipe it off when my money's dry. It's perfect.
Aren't you really making an argument, though, for central bank digital currency? Isn't that really where this is leading?
I'm willing to take any bet that in a decade we're going to have an implemented central bank digital currency, and most likely, if it's not 10 years, maybe 20 years down the road, we'll have no physical money anymore.
Absolutely.
It's
only 4% of our money is physical now. Anyway, we're 96% virtual already.
Is it 96%?
Yeah.
Wow.
Yeah, only 4% of our money is represented by the coins and bills. Literally 96% of our money now is virtual here in the U.S.
Wow. That's crazy. As Frank says, or ditch the penny to start. Yeah, I read something that the penny costs 4 cents to make. Like, that's just bad business right there.
Exactly. But again, let's follow Canada's example. Let's do loonies and toonies and get rid of the penny.
Get rid of that stuff. All right, last question here, and then we'll wrap up. Ganesh says, what's your thoughts on buying emerging market bonds at higher rates or higher yield across the world now that the difference between bond yields and stocks are close?
Well, the problem with any currency transaction like that is that you will get a higher yield coupon in certain economies, but once you try and then hedge out your currency exposure, you're back to a risk-free rate. So again, when you're doing an emergence market, corporate or sovereign, you've got that FX risk, not just the credit risk, if that makes sense. So a continuing strengthening dollar would hurt you. Because when you convert your money from the local currency back to dollars, you'll be buying less dollars. So, in the meantime, the good news is you might have enjoyed more income because of the higher coupon, but you're exhibiting a whole nother risk. So you really question is, what do you think about the dollar to answer that question?
Yeah, and when you look back at the dollar, the government is going to give you the best. It's one of the safer governments out there. Now that's in question. How stable is the government? Of course, the downgrade recently, but I mean, Ganesh, what are you going to do? You're going to go buy Turkey's 10-year government bonds and get 28%? It sounds amazing, but you've got inflation to the currency. You got an extremely unstable government. You can go to other areas. There's that risk reward, as Big Ed puts in a chat. It's always that discussion of risk versus reward. If you need 28% rate of return, well, maybe you do go buy some Turkish bonds. I can tell you, I wouldn't put a penny in them. not 1 cent.
Oh, remember, you're getting 28% in local currency.
Right, which is being
So when you
devalued.
convert that back to the dollar, that's where you're going to take the hit, assuming the dollar is stronger than that currency.
Yeah. And by the
So
way,
the good news is go ahead.
I'm going to correct myself here, guys. It is 2.72 cents to make a penny. It's 10 cents to make a nickel. There you go. That, you're making a product that costs $1 and you sell it for 20 cents. Like that's such bad business. I just can't even begin to comprehend the model. It's like we're already running bad government. This is just, another massive
and they
error.
Deteriorate over time and have to be replaced. That really makes sense.
Yeah. Oh, the beauty of it.
Yep.
Bill, tell me about what you got on your schedule. I have your site up here, and again, I'll post his name there. There it is. It is aftraining.co. There's the website right here for everybody out there. Anything new on your plate? I know you're always doing classes for the Fed and different banks.
Yeah. I'm very fortunate. Thanks to the internet and thanks to the new model of Zoom training, I'm training globally for a lot of my clients now. So, Monday night, I'm going to be up at midnight to do a class in Hong Kong. So that's really fun. I am living a weird schedule these days, but I'm glad to see my business grow globally. So that's been a lot of fun. For OTA, I've got the focus class now that we finally got started, where we do 1 day comprehensive. And that class is going to run next, I believe it's January 4th, first week in January. And we're 2 months into that process. And what I'm enjoying, I hope the participants are, is the weekly follow-up. We do the companion classes, and every week we get together. So to be able to continue a weekly dialogue and discuss this stuff on a weekly basis, I'm enjoying those classes. So the next one is going to be on January 4th. And truthfully, I apologize. I don't think they put it up yet, but I will have an XLT schedule. I do one a month, but we haven't quite gotten to the November schedules yet, I guess. So pending on the November, December XLT schedule.
Sorry, I had my mic muted there. I was typing not to
multitasking.
Trying to. I'm getting pretty good at it. So let me see. I was trying to find now. I think it might actually be over here. Bear with me 1 second, guys. I try to find this one up. Options. Bond markets, the canary in the coal mine. So if you go to, I'll post the link in the chat here for you guys. OTA has a bunch of different courses, and I would highly recommend, if you find interest in the bond market, which I think is one of the most powerful markets in the world. It's right next to mine. I'm the Discover Digital Assets and Crypto class, and Bill is over here with the bonds, the market's canary in a coal mine. So if you want more information, I put the link in the chat. You can click on that and find out more information about that course there. So as far as attending his classes that he does for, Goldman Sachs and all these big firms, probably not gonna be able to attend those ones.
Yeah, those are not open to the public, I'm afraid. But I'll tell you, I say it every time. Your audience is a lot more fun than my Goldman clients. You guys are a lot more fun, so I enjoy doing these sessions. So I thank you for the opportunity.
Maybe one day we'll do it. Maybe one day we'll do it in a Zoom format where everyone can have their camera on, which might make it a little bit more exciting.
That would be cool. But in the meantime, even in the questions and Q&As that I get on the XLTs and that, your audience is a heck of a lot more fun than my institutional clients. So thank you.
Love it. Awesome, man. Thank you very much for coming on. I appreciate it. And there's a question: what about Bill's book? Bill's books? Do you have any? Oh yeah, you have books.
The book sale still goes on. I was just saying to somebody, I'm going to have to pull that off because I have to save some books for next summer. Yeah, these are the books by Stuart Veal. It's a 3-book set.
Mm-hmm. I have them.
I was fortunate enough to edit them. You have them. That's right. You got them on an early set.
Yep.
And they're a $25 offer. Honestly, it's something I make available to my institutional clients when I do my beginner training programs for people new to the industry. They're great at the introductory level. So I decided about a year ago, maybe longer, to offer it to you guys and just cover shipping charges. So you get all 3 books and it's $25, and that basically covers my shipping charges.
Nice.
But the books are very comprehensive and introductory in nature, though.
Yeah. These aren't super complex, but they're very good, especially for somebody who wants to understand how these markets work. You got equities, fixed income investments, and then derivatives. And you can see that special over here, $25 there. So there you go. Awesome.
Thank you, Marlon. Thank you.
My pleasure. Yeah, I got to give you a plug,
The books. There you go. And my thanks to whoever asked about the books. Thank you.
Yes. Well, you always bring something of value, whether it's the books for sale or just the content on this program. I appreciate it. I look forward to having you on next month, and we'll talk about the expectations for the December Fed meeting.
There you go. We'll parse every adjective and every adverb.
There you go. And by the way, I guess you can take one beer off my tab because Apple did beat earnings expectations. So there you go.
What a surprise. Who would have believed it?
All right, Bill. Thank you very much, my friend. Have a great evening. Take care.
You will. Thank you.
All right.
Bye now.
Guys, that was Bill Addiss. He's one of my mentors in the bond market world. He knows a ton about bonds, and I love the fact he comes on here and shares a lot with you guys. So hope you enjoyed there. You can go to aftraining.co to get more information on those books out there that I mentioned. All right, let's go real quick and shift over to our equity markets. As you guys know, I opened up a short position on the NASDAQ 100 right near the end of the day. I tripled that position as the day progressed, expecting Apple to have horrible earnings. And right now, Apple is down 3.62%. Thank goodness. As you see here, they did, as Lisa says, they slightly beat. They're supposed to come out at $1.39. They came out at $1.46. So they did beat, and their revenue was slightly higher. So honestly, that's a surprise to me. I did not think they were going to beat it. I just don't see that iPhone 15 selling. I think it's kind of I don't know. I just didn't think it was going to go. Anyway. We're looking at Apple right now in the after-hours session. If you go over here on the 5-minute chart, you can see that they released their earnings early. It looks like they released at 1:30. They're supposed to release at 2, and then all of a sudden it just dropped more and more and more and more. So we'll see how this goes going forward into tomorrow. I will be closing out my entire position of the Qs tomorrow. I don't plan on holding those long-term since I bought short-term maturities on my options or short-term expiration on my options. But that is the catalyst for a nice little down move here in the futures. Although you can see right as the Apple earnings came out, it sold off and then has rallied back up. So the NASDAQ is down just a little bit here. I certainly needed to fall a bit more to make my day for tomorrow. All right. Yeah, let's see what happens. I'm not even worried about the end of the day, Lisa. I'm curious what's going to happen when the market opens up. I have a feeling it's going to open up, and in typical Apple form, you'll get the bottom feeders who are like, "Oh, it's down 3%," and that thing comes screaming up, and that could be bad for my my position. Time to sell more Fortinet puts tomorrow. I didn't look at it. What did it do today? Oh, good. You know what? Actually, it's funny because I had the 46 puts. I sold the 46 puts, and I actually pulled the plug on those. I made a profit, small profit. Boy, I might actually be hit. But yes, I agree with you, Big Eb. I might sell some more Fortinet puts tomorrow. Yep, absolutely. Capitalize on that fear, right? You got these people freaking out. Oh my God, I want to sell. Okay. I'll look at the daily here on FTNT. We're right now at 46, which is the low point down here. Maybe I'll go out and try to sell those 42s. Why not? I'm down for it. I'm down for it. I'll probably sell some tomorrow. That's right. Bottom feeders, peasants. That's right. Absolute bottom feeders. Looking for deals. Let's just look real quick at the top 7. I want to make sure I don't do another 1 hour show today. You guys got lucky yesterday. Here is your dollar index. Right, on the day, down 0.48%, but still just traversing sideways. Unless we break that lower yellow line there, I'm not concerned. The 10-year today actually had a big down day, but the new session is just rolled over, so it's slightly up there. You guys are going to add in 45 seconds. I may be able to finish all of these in the next 45 seconds, but we'll see. Gold, up 0.3%. Again, nothing really that exciting from a technical perspective, right? Small candle, topping and bottoming tails there, not that big of a deal. So no real clear direction on what's going on with gold, although it does look bullish at this point. Those last 3 days have been pretty negative on gold. Bitcoin up 0.96, so we're back above that 35,000 mark. The bad news is we really surged much higher today. This Bitcoin futures at one point today, we hit a high price of 36,575. And now we're back down to 35,300. So it's definitely sold off a little bit in today's session from its peak, but all in all, 0.96% gain last 24 hours, not too shabby. NASDAQ is the one that has me just scratching my head as to why we saw such a big rally today. 1.72% move up in the NASDAQ, just absolutely ripping today in these broad market indexes. Actually, before I go any further on this one, I was expecting it to stall right here and sell off. It did not. We're ripping higher. We'll see what happens on tomorrow's session. But look at Apple. If you look at Apple's chart, we had drawn this downtrend line on Apple a while back, and we are literally right at it. 177 was the point where you can write in that trend line. So it's actually kind of a perfect spot for this thing to start to sell off from going forward. And let's see, S&P 500, 1.87% move to the upside. your ultimate stopping point is 4,400. Anything higher than that, than this downtrend that's been intact since August, looks like it could potentially reverse here. So all in all, I'm still thinking bearish. I still like the downtrend overall in the broad markets, but you got this real big, surge of hopium that was created by Jerome Powell's actions on Wednesday. And we'll see if Apple helps fuel that tomorrow. Crude oil, 2.51% move to the upside today. Technically, no big deal. We did break down below that 82 mark and close below it, which I did not like. But all of a sudden, you've got a little pullback here in that after that breakdown. I don't see anything that significant here on crude oil that's leading me to believe I should be buying, selling, or even holding it. So I'll stay away from crude oil. Now, the Russell, the one that I was saying 4 days ago would be a good buying opportunity because it's right at the lower end of our range at 1650, has been screaming up ever since. Of course, I'm kicking myself for not having bought the Russell. I was going to buy the Russell and I was going to buy the NASDAQ and ended up going with the NASDAQ, unfortunately. But I got out of that NASDAQ very quickly. 5% in the last 4 days for the Russell from bottom to top. Great move up. There really is no strong supply zone here on the daily. We could break it apart to a smaller time frame and maybe find something there. But all in all, still in a big downtrend. Just a nice bounce back to the upside. So there's your major 8 market pieces to look at. Tomorrow's Friday? Yeah, it's Thursday today. Yep, I'm losing track of time. We'll probably have a lot to talk about on that Apple trade and how it impacts the NASDAQ 100. I have a pretty significant position now, which I will be closing out hopefully at some point tomorrow. I have 80 put options on the NASDAQ, so that's getting a little bit big for myself, but right now that's down. It's got a good loss to it, obviously because of what happened on the rally, up 1.7%. But added to that as this thing started to roll over near the end of the day. So I feel okay. If I get a little bit of a pullback, it'll probably bust me into break even, if not positive territory. So hopefully the Apple earnings will gap us down tomorrow. I'll let you know how that one all pans out. Again, I want to thank Bill Addiss for coming on the program today. I do need to get you guys your earnings calendar and economic calendar, right? I did not do that. So let me bring up your economic calendar for tomorrow. Earnings are boring. There's really nothing going on the earnings front, so I'm going to skip that one for tomorrow. But here is your economic calendar. For Friday's session, it's also rather quiet. There's a couple announcements for the U.S. Average hourly earnings. Let me make this a little bit bigger for you guys. There we go. Average hourly earnings, non-farm employment change, and then the big one is the unemployment rate. That's going to be coming out at 5:30 Pacific time, so 1 hour before the markets open. That is a pretty important number right now. They're expecting to stay at 3.8%. I guess I'm done trying to forecast because it seems like every time I come up with my hypothesis for unemployment rate, it's off. Like I do feel like we're going to start seeing this drift back up to the upside. It just hasn't happened. You also have final services PMI, ISM services PMI, and that will do it for your day tomorrow. So there's your economic calendar. Hopefully there'll be some action and some moves for you guys. Again, if you have any comments, questions, feedback, let me know. Send them on in at TraderMerlin@gmail.com or put it down below any of the YouTube videos, and we'll get to all those questions tomorrow. Thank you, everybody. Have a great Friday. We'll see you then.